Good evening and welcome to tonight's meeting of the Commonwealth Club of California. Find us on the internet at commonwealthclub.org. I'm Bruce Erickson, Managing Partner of the San Francisco office of Pillsbury Winthrop Shaw Pittman and the Commonwealth Club's quarterly chair. It is my pleasure to introduce our distinguished speaker, Richard Fisher, President and CEO of the Federal Reserve Bank of Dallas.
Let me come back to monetary policy and the Fed. It is only natural to cast about for a solution, for any solution, to avoid the fiscal pain we know is necessary before we succumbed to complacency and put off dealing with this looming fiscal disaster. Throughout history, many nations, when confronted by sizable debts they were unable or unwilling to pay, have seized upon an apparently painless solution to this problem. It's called monetization. Just have the central bank, the monetary authority, run cash off the printing presses until the debt is repaid, and then promise to be responsible from that point on and hope that your sins will be forgiven by God or Milton Friedman or anybody else. We know, however, from centuries of evidence in countless economies, from ancient Rome to today's Zimbabwe, that running the printing press to pay off today's bills leads to much worse problems later on. The inflation that results from the flood of money in the economy turns out to be far worse than the fiscal pain that those countries hope to avoid. Earlier, I mentioned the Fed's dual mandate to manage growth and inflation. In the long run, growth cannot be sustained if markets are undermined by inflation. Stable prices go hand in hand with achieving economic growth on a sustainable basis. And I have said many, many, many times that inflation is a sinister beast. If you uncage it, it devours savings, it erodes consumers' purchasing power, it decimates the poor, it destroys returns on capital, it undermines the reliability of financial accounting, it distracts the attention of corporate management, it undercuts employment growth and real wages, and it debases the dollar. Purging rampant inflation and a debased currency requires the administration of harsh medicine. We've been there. And we know the cure that was wrought by the Open Market Committee under the leadership of Paul Volcker. Even the perception that the Fed is pursuing a cheap money strategy to accommodate fiscal burdens, should it take root, is a paramount risk to the long-term welfare of the United States economy. The Federal Reserve will never let this happen. It's not an option, ever, period. The way we resolve these liabilities, and resolve them we must, will affect our own well-being as well as the prospects of future generations and the global economy. Failing to face up to our responsibility will produce the mother of all financial storms. The warning signals have been flashing for years, but of course we find it easier to ignore them than to take action. Will we take the painful fiscal steps necessary to prevent the storm by reducing and eventually eliminating our fiscal imbalances? Well, that depends on you. And I mean you, literally, the people in this audience. This situation is your creation. When you berate your representatives or your senators or presidents for the mess that we're in, you're really berating yourselves. You elect these people. They serve the will of the people. You're the ones, every single one of you, when you look in the mirror, think about this. You're the ones who let them get away with burdening your children and grandchildren rather than yourselves with the bill of these entitlement programs. And by the way, the issue transcends political affiliation. When George Shultz, who's one of San Francisco's greatest Republican public servants, was director of President Nixon's Office of Management and Budget, he became worried about the amount of money that a Republican president and a Congress was proposing to spend. And after some nights of tossing and turning, he called the legendary Office of Management and Budget staffer, a man named Sam Cohen, into his office. Sam Cohen had an encyclopedic memory of budget matters. He had been there from the very beginning, and he knew every zig and zag of budget history. Sam, Schultz asked, tell me something, and let's just keep it between you and me. Here we are in the middle of the night in the White House, and I just have a question between the two of us. Is there really any difference between Republicans and Democrats when it comes to spending money? Well, Cohen looked at him and furrowed his brow, thought about it for a while. And then he replied, Mr. Schultz, there's only one difference. Democrats enjoy it more. And yet, no one I know, Democrat or Republican, enjoys placing our children or our grandchildren and their children and grandchildren in harm's way. No one wants to see the frightful storm of unfunded long-term liabilities destroy our economy or threaten the independence and authority of our central bank, the Federal Reserve, or tear our currency asunder. Of late, we've heard many complaints about the weakness of the dollar against the euro and other currencies. It's been argued in the op-ed pages of the Financial Times that one reason for the demise of the British pound was the need to liquidate England's international reserves to pay off the costs of the two world wars. In the end, according to that argument, the pound was sunk by the Kaiser's armies and by Hitler's bombs. Well, right now we, you and I, are launching fiscal bombs against ourselves. You have it in your power as the electors of our fiscal authorities to prevent this destruction. And the reason I came here tonight is to please ask you to do so. Thank you. And now, in customary central bank fashion, I will do my best to avoid answering any questions that you might have.